Hello, everybody, and welcome to Markets Overview March 2020 edition. A quick introduction. My name is Goran Ognjenovic. I am the founder and the chief investment advisor for Independent Investment Advisors. We're wealth management practice located in Portland, Oregon. We focus on clients in Oregon and Washington. We focus on financial planning, financial advice, as well as portfolio management. And as a byproduct of what we do, we also try to reduce the complexities of financial investing, and we try to provide investment education to our clients. Here's my contact information and our company's website address. The agenda for this edition of the Markets Review blog is a little bit different. I've got some feedback from some of you guys, and I've added a couple of really major pieces of content to this. One is I rounded up some economic indicators I thought were important to look at, and I went through, so that's one. And then number two is I went through my portfolio, so the really clients portfolio of the clients that I manage, and then I picked out three portfolios that I'm gonna label sample portfolios. They're actual live portfolios that I'm gonna keep tracking from now. They're very different in terms of their composition, performance, and things like that. So we're gonna look at that starting in this video, and then I will review how those are doing every month. And then lastly, we're going to look at market indexes just like we have before. Excuse me, I've got a little cold, so bear with me here. Disclaimer, standard disclaimer, right? So anything I say is really to be used as educational tool, should not be construed to contain investment advice. Investment advice needs to be tailored to an investor's specific needs. None of the information contained in the market overview and inside blog should be construed to be investment advice. If you're looking to tailor a plan to your own needs, you need to seek an advice of a registered investment advisor. Give me a call and we can put some together for you. Also, there's a higher degree risk of investing and trading. We assume no responsibility, and then principals of our company may or may not directly or indirectly have positions in securities or derivatives that we talk about in these comments. In other words, do not try this at home. Everything I talk about is really for educational reasons. General investment comments. So we manage really two types of investment programs. One is allocated portfolio. This is vast majority of all of our clients. This is your retirement saving, your trusts, your business investments, kind of a longer term, mid to longer term investment goals. The way we sort of put this together, we get together, we talk about what you're trying to achieve, we define what those investment goals are, we come up with a portfolio of assets, we invest in those assets, and then we sort of modify allocations as we go along based on market conditions. And then the second thing we do is a tactical portfolio. Now this is actively traded portfolio. It's primarily indexes, ETFs, and some individual stocks, maybe a little bit of options. But it's very actively traded. It's for an aggressive investor. It's for really sort of driving income out of the market, short to mid-term investment goal. It's a very volatile portfolio. It's got substantial tax impacts, and I've really only screen for we screen pretty heavily for the types of investors that can participate in this program, right? You have to qualify in a lot of different ways. Anyways, outside of that, generally speaking, we're always invested, but our asset allocation ratios change. based on market conditions. And one of the major things that we have, one of the major advantages that we have, is we're small and boutique, and we only work with a small number of clients, meaning I don't have billions of dollars that I need to move through the market. And so because of that, um, I can I can wait, I can react, I don't have to anticipate. So we can look at the market action, we can look at the price action, we can look at how market reacts to good news, to bad news, and then based on that information, change our allocations, deploy capital, and things like that. So that's generally how we sort of operate, how I operate, um, from a general sort of guidelines, right? Next, I'm going to jump into some of these economic indicators. Now, I pulled a whole bunch here, and there's a lot of economic indicators out there. I pulled probably six, I think 6 or 7, the ones I thought are relevant. And one thing I did is I did pull them excluding this last 2 weeks of March, because I wanted to show some trends prior to the coronavirus impacts of where the economy was and how I think it was doing, right? So, U.S. inflation rate, I think this one's pretty self-explanatory, right? I think everybody understands what inflation is, hovering around 2.3%. Um, I'm going to talk a little bit about, when I get to the bond section, why this is so problematic. We have interest rates that are sub 1%, and we have an inflation rate that's at 2%. So very, very difficult to be in cash right now, right? Or to be in fixed income investments, because essentially your money is losing value more than you're appreciating it through debt instruments. Um, Unemployment rate. So a really nice thing about this, again, this is before the coronavirus impacts. One thing I want to sort of highlight here, look at this downtrend, right? So the went from 3.8% down to 3.5%, trending in the right direction. Um, this is now very, very different. In the last 2 weeks, I think we had $3.2 million initial, 3.2 million initial claims, not last week, but the week before, and then another 3 million last week. So I think this is now just sort of jumped up to probably 12, 13%. But I'll include those numbers next time. Labor force participation rate. So these two are the participation rate and unemployment rate are sort of tied together, right? The unemployment rate measures the employment of people that are in the labor workforce, and then this one measures how large is that labor workforce, right? So one of the things that we see here is also another trend moving up over the course of the year. So more and more people are joining the labor workforce, probably for several reasons. One, there's need for employees. Companies are looking to hire. There's a lot of opportunities. People are calling. So if you were maybe a stay-at-home mom or stay-at-home dad, or a stay-at-home parent, and you weren't working, now all of a sudden maybe there's some part-time opportunities, and you're all of a sudden working, and things like that. So far so good, right? Very positive developments from an economic employment perspective. GDP, gross domestic product, right? Sum of all the products and services generated in the United States. This is a growth rate chart, right? So we have we're hovering sort of around 2%. Um, we've come down a little bit from last year. We've had a tremendous amount of growth. I mean, an economy of size of the United States, running at these 3+ levels is really, really hard, right? Because it's a large, very, very large economy. So 1, 2, 3% growth is really substantial, right? So looking positive, right? Kind of hovering. We were hovering around 2. We had a little uptick right here, and we've come off of that to plateau. Obviously, we're going to have a substantial impact of this with the coronavirus shutdown. All right, moving on. Now, this is one that is really sort of worrisome, and I think I read a lot of economic papers and opinions, and they don't really have economists don't really have an answer for why this is happening, right? So we are not seeing the wage and the salary growth, right? So as I'm going to flip back to a couple of these. So you've got inflation rate that's doing this. You have unemployment rate which is doing this. So you would think that the candidate pool and the employee candidate pool is smaller. You would think that companies would start to pay more, but we're not seeing that, right? And that this is one sort of indicator that's not and not really pointing the right way. Um, there's not really a lot of thesis as to why, but we're seeing wages and salaries, essentially the growth rates coming down. So we're kind of stagnating there. Consumer sentiment. Um, this is a survey-based economic indicator, right? And so we have, I don't know what happened here, but last 6 months or so, prior to obviously the coronavirus here, we've got substantially improving consumer sentiment, right? That's a 10, 11% improvement on that. Meaning that people are feeling more confident about their jobs, the future, spending, and things like that. And then one other one that I thought would be kind of important is I tried to look at and keep an eye on the big items in the economy, right? Because so one of those big items is housing, right? I keep look at the housing starts, housing the pending numbers, house pending numbers, right? See how's the housing market working, right? Because if the economy is doing well, people are spending money, the prices of homes are going up. Some of that happens internally, some of that also happens externally as foreigners are coming in and moving to the United States, making investments in the United States. And so this is running pretty steady, right? We've got sort of this 0.03 um, change, right? So 0.03% change in month over month in terms of what the equivalent house prices are this year versus the previous month, right? So economic indicators looking pretty good, right? In my February edition, I talked about um, coronavirus situation being kind of a black swan event for the markets. And if you look at these indicators we just reviewed, right, you'll understand why I was referring to it as black swan, because from an economic indicator perspective, the economy was doing strong, employment was doing strong, consumer was doing strong, and then we had to shut the country down. So we'll have to see. Um, Probably April, I think, will be telling in terms of indicators. We'll have to see what this is going to look like over the next couple of months. One thing that I want to jump back up to this point right here, right? So for us, the way I manage portfolios, the way we manage portfolios is I really don't put a whole lot of weight to these economic indicators. What I do look for is when these numbers are announced, how the market's reacting to that, right? So you can't really go because sometimes good news is good news, and sometimes bad news is good news, and sometimes good news is bad news, right? Depending on what the market expectations are and what the interaction is with the federal government and the Federal Reserve and foreign investors and the strength of the dollar. And there's a whole bunch of different sort of things that play together in a complex market. So I look at this stuff, but it's not really the primary um, thing that I look at when we build portfolios, when I build portfolios, or when I change allocations of portfolios, right? I primarily look at how markets responding to certain news, right? So a lot of chart and technical analysis in our day-to-day kind of thing here. All right. So moving on. So allocated portfolios. So I mentioned a few slides back, right, that we run two programs. One of the program is an allocated portfolio. Most of our clients are, a vast majority of our clients are in the allocated portfolio. Um, and so what I did is I went through my client portfolios and I picked three. These are actual live portfolios, right? Actual money deployed in the market, invested in various different things. But what I'm going to do is I'm going to report on every month on how these are doing. They're very different in terms of their composition. They're very different in terms of the client's investment goals, and really for educational reasons, right? I want to show some of you how a differently allocated portfolio is going to perform both in a good environment as well as in a challenging environment. And just to give you a sense of how all that sort of works, right? Sometimes it's hard to keep track of that. So the first portfolio is a trust brokerage account set up for young children. This particular one has a 30-year time horizon as of January 1st of last year. We have the trustees contributing monthly, right? So they've seeded the accounts, and then there's a monthly contribution. It's almost like your 401k or an IRA. There's a monthly contribution to the portfolio. Since it's 30 years out, right, we've got this one in an extremely aggressive allocation, right, and it's using margin. So very, very long time horizon, very aggressive portfolio, and we'll take a look at, I got some details on how it performs, right. Portfolio number two is a retirement IRA portfolio. It's got a 20-25 year time horizon as of January 1st of last year. It includes annual contributions based on maximums, right? So whatever that maximum is, I think it's $6,000 per individual. And then it's a mid to aggressive allocation. I mean, we're still sort of 20-25 years out. It's not as aggressive as the first one. Obviously, you can't use margin on the IRA portfolio. So the allocation is a little less aggressive than the first one, but what makes the first one even more aggressive is the margin, right? It's the leverage. We're using leverage to buy things and then at the right price levels, and then the continuous monthly contribution are sort of backfilling that. So it's I think we're going to see a compounding. If we're going to see an increase in compounding return quite a bit on that. And then a third portfolio is sort of all the way to the right, which is a very conservative portfolio. It's a retiree portfolio. Clients already in retirement, really as of January of this year. They're estimating they're going to need 20 years of income and capital preservation. They're not making any contributions, and it's a very conservative allocation. All right, so those are the three portfolios. A big disclaimer. Again, I want to remind everybody, right? So these are for educational purposes only. Please do not try to replicate this. I watch these every single day. I make changes based on these based on market conditions. do not try to sort of replicate this, on your own. And by no means this is an advertisement or investment advice or anything of the sort. It's really just an educational video to show how these portfolios behave in various different kinds of environments. All right, so let's jump into this. So first things first, this is advisor's view, right? I started doing this last video. So this is my view, right? All the portfolios for all the clients aggregated at my level. This is sort of what that distribution looks like. It's a 41.78% in equities, 51.53% in fixed income. We got some other things sprinkled around. 90% of it is the United States. I talked a little bit about that before. And then a little exposure to Asia and Europe. And then actually pretty decent distribution here across different equity categories, and then obviously the 51% is in treasuries, right? So I guess in some ways you could look at this as a portfolio as well, right? Because it really is, with a sort of a 50-40 allocation, 50 in fixed income and 40 in equities. This would be something like, let's say you're maybe 10 years away from let's say if it's a retirement portfolio, you were 10 years away from retirement, or maybe even a little less. It is really sort of where I think you'd see this kind of allocation. And so here's the performance. I'm going to start filling this out as we go forward here. And then obviously next year I'm going to include the previous year, but negative 0.42% in January, lost about 3.7% in February, and then lost about 8.67% in March. Total year-to-date performance is minus 12.79%. So we're in a contraction territory when it comes to this this piece. All right, moving on. Here is the trust portfolio, right? So number one, this is the aggressive portfolio. So I want to highlight a couple of things here. One, look at this equities exposure, right? 92% equities exposure. This portfolio has really no fixed income. It's got some real estate exposure, and so very aggressive allocation. 92% in North America and Europe, a little bit of Asia, and then here on the sector side of things, you would expect technology, right? Because technology is kind of the growth engine, generally speaking, right? You would expect to see very low exposure to utilities. Healthcare is another growth area, right? And then consumer cyclicals is another growth area, right? You're gonna see low exposure to commodities, telecom services very low, right? So that's kind of what an aggressive composition looks like. Now I'm gonna show you the difference here, right? So look at the difference in performance between this portfolio and what we were just looking at, right? So this portfolio is down 44% year to date, right? Whereas this one is only down 12.79% year to date. So huge difference. So something like this is going to be substantially more volatile, right? And this has to do with margin. Oh, one thing I need to mention, right? So in my February video, I talked about going into March, I had about 10% of capital to deploy on these equity weighted portfolios. And when the market started correcting for coronavirus, I margined this particular portfolio, right? I was out of cash. I didn't have any more cash. I didn't anticipate the coronavirus, but the opportunity was presented. So we went out and margined this. So the initial was 2 to 1, right? That's sort of the initial margin on that, and that's why you're going to see um, this number being so scary, right? Because I think market corrected about 30. This will be substantially more than market. But on the once things turn around, the key to this now is you need to manage this margin, right? Margin is not a bad thing if you know how to manage it. If you read in the press, you're gonna see statements like, "Oh, you lose a lot more money," and blah blah blah. But you just need to manage it. You understand. You need to understand. You need to be. You can't get too aggressive. You need to have your cushions um, in place. You need to understand how certain things are margined, how they impact your portfolio, and things like that, right? All right, I'll move on here. And here's the IRA portfolio, right? So this is that 2025 year. So it's still fairly aggressive, right? I've got 68% in equities, 18% in fixed income, some real estate, some miscellaneous other assets. It's a little bit more distributed, right, across kind of the top tier economies. Um, and then, still as you would expect, right, um, different fairly distributed allocation here. You're going to see small numbers in utilities and telecom. You're going to see big numbers in technology, and then basic commodities. Right, you're going to see small percentages there. And here's sort of how it behaves. This one's pretty much tracking the market. There's one area I would expect that this portfolio to actually do a little better than the market. Um, But what's happened is energy. So, in addition to coronavirus, we have a situation where um, Saudis and Russians are going to war, economic war over oil, and they're driving they're driving the price of oil down, which is having impact on U.S. energy companies, Exxon, Shell, BP. I mean, it's a whole bunch, right? A big percentage of our industry is oil, right? Think state of Texas, and that's what's been driving this thing down. I would expect this thing to be um, performing a little bit better than the overall market. All right, and then the last but not least, here's the retiree portfolio. And so you're going to see these ratios are just completely flipped, right? So 84% of this is in fixed income, about 14% and 15% in equities, in all North America, a little bit in Europe. Um, and what you're going to see here, right, is you're going to see, so first of all, you got a very small allocation, but then you're going to see sort of, not a, technology is going to be a very small percentage. Um, consumer cyclicals are going to be small percentage, right? This is non-cyclical. This is grocery stores, right? Things that don't don't swing a whole lot. They don't have a lot of volatility, financials, and things like that, right? And so, as you would expect, the performance of this one is substantially better than the than the first one I went over, but it works both ways, right? So um, when the markets roar, right, this portfolio is going to lag substantially. But this particular client, right, they're in retirement. They can't afford to have 40% loss of capital, right? Even though if it's temporary, they need their income. They need to have, safety of that base, and this portfolio is really sort of built for them. And so one of the things I do as I go forward here, right, is I adjust these based on market condition. I mean, I'll go through and adjust these here, and then I'll adjust these, and that's true for all of these allocated portfolios, right? It's not a set it and forget it. I sit here, I watch the markets, I look at, I don't know, 12, 1300 charts a day. Um, and so based on what's going on, I will make some adjustments. And then lastly, the tactical portfolio, right? I talked about two programs that we run. One program is the allocated portfolio, and the second program is the tactical portfolio. I debated whether I wanted to even show this um, because it really doesn't fit a lot of clients, right? The very, very small percentage of clients are suitable for something like this. But I ended up including it just for educational reasons, right? So people can understand, both sides of it. So this portfolio, right, is returning 17.49% for the year. Made a 6%, 6.6% return in January, then had a 7.37% loss in February, and then had a 14% gain in March. And like I said, this is a very volatile thing, so I mean it's going to do a lot of this, right? And then at the end of the year, you're going to have to pay taxes um, on a lot of that because a lot of these trades, it's an actively traded portfolio, so a lot of this activity is going to be short-term gains. So not only are you going to have to pay taxes, it's all going to be short-term capital gains, which means it's going to, tax at whatever income bracket you are. So I included it. I'll probably take it out at some point, just for educational reasons. But that's kind of how that one's doing. All right, so moving on to indexes. We're sort of back to the regular programming here. So S&P 500. So I want to talk a little bit about what's happened. So this was so fast. This is a weekly chart, by the way, right? So this correction was so fast. I've gone back in time as far as I have access to data, and I've never seen anything like this. Where you lose 10% when the market moves 10-15% in a single day, right? So we had a huge 3 week, you know, correction here. It's not correction. I mean, this is a crash. And essentially, what we've done is we've erased 3 years of price action, right? 3 years of value. So we're sort of back at this. Oops, that's a terrible line. Let me get rid of that. So we've sort of erased, you know, 3 years of this growth. And so to some people, when you look at this, you're like, oh my God, this is so scary. But to me, this is a huge opportunity, right? We now get to buy, um, we get to invest at the prices we haven't seen in 3 years, right? So this is why I ended up leveraging that aggressive portfolio, right? Went out on margin. Um, and we'll see how all that works out. But I don't have a whole lot to talk about this. Um, we may, in terms of my anticipation and expectation, I don't. This has moved too much. Um, I don't think this recovery is gonna look like this, right? Where we're gonna shoot straight up. I think we're gonna meander here in sort of this range, with some kind of a upward tick or upward bias for the rest of the year. Now, if the coronavirus situation does last, right? So it's April 7th today. Let's say we're here in May 7th or maybe mid-May, and things haven't improved. We haven't opened the economy up. I would expect this to turn back around and come down, retest these levels, these lows, and then possibly even go lower, right? Yeah, so the the economic impact of what we got going on right now is really about people out of work, right? Airlines are not flying, restaurants are not serving, hotels are empty, all the conferences are canceled. Uh, you know, so it's a cascading effect of things. Um, so will be interesting to see where this goes. Russell 2000. Same kind of thing, right? This is the mid and small companies, US based. Um, One thing you're gonna see, right? Russell tends to move differently than S&P. S&P 500 is more volatile. So if you see here, right, we've actually lost 4 years. We've gone all the way back to 2016 lows. So again, huge opportunity, right, to now buy some of these companies. There's some good companies. There's some really strong, innovative organizations in this index. You have now opportunity to buy them at these prices. So I don't have a ton of commentary really on the indexes like I normally do. We're kind of in a correction land here. So and then here is the East. So this is Morgan Stanley East Asia. I'm sorry, Europe, Asia, and Far East Index. And on the few times I've hinted as to why I like to be US weight. So if you look at this index, this thing is corrected all the way back to 2012 lows. So if you bought, let's say we were having this conversation 8 years ago, and you got invested right here, basically then the whole investment has gone to zero. Now it's not entirely true because you've collected dividends, all along here, right? So you've seen some growth, you've seen some accumulation, but it's just too big of a swing, right? That's just a huge, huge swing. And you have to participate, and you want to participate, right? I just don't like to put a ton of weight to it. On the Europe side, and maybe I need to pull Europe out of this because I think Europe is going to be a little different, probably a little milder. But Asia and Far East will kind of react this way. All right, and then bonds. So let's look at bonds. I cried wolf a little bit in my last video because of these yields. I'm gonna cry wolf again. I mean, this is a real problem, right? It's so good for people buying houses. Rates are low, you can afford more house. If your HELOC rates are down, your credit card rates are down. There's a lot of money in the economy circulating, so that's all positive. But if you're a retiree, you are going to be really struggling, which is really unfortunate because we got a lot of people, from a societal perspective, we got a lot of people retiring. So here's a 10-year. This chart is really sort of 10-year. That's a terrible highlight here. So this chart right here is a 10-year government bond across the globe. 0.67% US. Germany continues to be in negative yield territory. So if you want to see any kind of income, bond income, you got to go to places like India, or where's Brazil? There's Brazil, right? Mexico. You got to go to these economies that are not as strong. The bonds are not as safe. I mean, there's a reason why they yield these higher rates. So, what are you doing, right? If that retiree portfolio that I talked about, we're moving more money out of bonds into sort of hybrid vehicles, right? Like staples, consumer staples, utilities, telecoms, and things like that, right? It's equity, right? So the volatility is going to increase, but at least we're getting some yield. I think we're getting 2.345% of yield on some of those assets. So it's a challenge, right? It's definitely a challenge. And then this table over here, I've got U.S. only, and so you look at some of these numbers, and so if, for a 30-year US bond, you're making $1.27 on that. One of the things that I've been looking at in this quest, that portfolio is the most challenging for me right now, the retiree portfolio. The rest of these are, fairly easy to adjust the allocations and move percentages around, but the retiree portfolio is a challenge. So one of the things I'm looking at is municipals, and I'm also looking at TIPS, which are sort of the treasury. They're treasury bonds, but they're tied to the inflation rate. Uh, but they have some tax impacts, so you got to kind of run some numbers and see if they make sense. So, anyways, that's it. That's all I had for the March update. And sorry, this one is a little longer than the previous. We're running about 40 minutes here. But if you've got any questions, get in touch with me. My contact info is right there. Otherwise, I hope you guys are staying safe and sane, and I will talk to you soon. Have a good one.